In the 1980s, under the IMF SAPs, many countries in Latin America experienced severe economic downturns, with high levels of unemployment, social inequality, and poverty. Established in 1944, the IMF has played a significant role in global finance. However, criticisms of its policies and practices have been pervasive. The birth of the IMF, 1944. The IMF was established at the Bretton Woods Conference to promote international economic cooperation and stability after World War II. However, its initial policies, such as fixed exchange rates, proved challenging and ultimately contributed to the collapse of the Bretton Woods system in the 1970s. In 1971, the United States ended the convertibility of the dollar to gold, disrupting the fixed exchange rate system and undermining the IMF's original framework. During the 1980s and 1990s, the IMF implemented structural adjustment programs, SAPs, in developing countries facing economic crises. These programs required countries to adopt neoliberal policies, including fiscal austerity, market liberalization, and privatization. In the 1980s, under the IMF SAPs, many countries in Latin America experienced severe economic downturns, with high levels of unemployment, social inequality, and poverty. The IMF has intervened in currency crises to stabilize economies and restore confidence in financial markets. However, the conditions attached to its financial assistance often included strict policy measures that impacted social welfare and economic growth. During the 1997 Asian financial crisis, countries such as Thailand, Indonesia, and South Korea received IMF bailouts, but had to implement austerity measures, leading to significant social hardships and economic downturns. Controversial loan conditionality explanation. The IMF provides loans to countries in financial distress, but these loans often come with conditionality. These conditions require countries to implement specific economic policies, such as reducing government spending or implementing structural reforms. In the early 2000s, Argentina faced a severe economic crisis and received an IMF loan. However, the conditions attached to the loan, including fiscal austerity measures, were met with public protests and social unrest. The IMF has played a role in managing debt crises in developing nations. However, its approach has been criticized for favoring creditors and imposing harsh austerity measures on debtor countries, leading to prolonged economic challenges. In the 1980s, heavily indebted countries in Latin America, known as the «lost decade», faced economic turmoil, as they struggled to meet their debt obligations under the IMF's prescribed policies. The IMF has advocated for financial liberalization, promoting the removal of capital controls and encouraging open financial markets. However, this approach has been blamed for facilitating speculative bubbles and exacerbating financial instability. In the late 1990s, the removal of capital controls in several Asian countries, following the IMF's recommendations, led to excessive capital inflows and fueled the subsequent financial crisis. The IMF often recommends fiscal consolidation measures to address budget deficits and debt levels. These measures can include reducing government spending, increasing taxes, and reforming public services. In response to the 2008 global financial crisis, many countries implemented austerity measures under IMF guidance, leading to reduced public investment and social welfare programs. Conditions for trade liberalization explanation. The IMF encourages countries to adopt trade liberalization policies, including reducing tariffs and removing barriers to international trade. The goal is to promote global economic integration and boost economic growth. In the early 1990s, several African countries implemented trade liberalization policies as part of IMF-mandated structural reforms. However, the sudden removal of trade protections led to a decline in local industries and job losses. The IMF has often advocated for privatization of state-owned enterprises as a means to enhance efficiency and attract foreign investment. However, the rushed privatization processes have been criticized. for benefiting a few elite groups and neglecting public interests. In the 1990s, under IMF pressure, many countries in Eastern Europe privatized their state-owned enterprises, resulting in widespread corruption, wealth concentration, and increased income inequality. The IMF plays a role in managing and mitigating financial crises worldwide. However, its response has been criticized for relying on standardized policy prescriptions that do not consider the unique circumstances of each country. During the 1998 Russian financial crisis, the IMF's approach of imposing tight monetary policies and fiscal austerity worsened the economic downturn, leading to social unrest and economic decline. Governance and representation issues. Explanation. The IMF's governance structure has faced criticism for its lack of representation and decision-making power for developing nations. There have been calls for reforms to enhance the voice and participation of these countries. As of 2021, the voting power of the largest economies, known as the IMF-5, including the United States, Japan, Germany, France, and the United Kingdom, has significant influence in IMF decisions, raising concerns about equitable representation. The IMF's dark history is marked by controversial policies and their far-reaching consequences on economies and societies worldwide. Understanding these aspects helps shed light on the challenges faced by nations under the influence of the IMF and calls for ongoing reform to ensure more inclusive and sustainable global financial governance.